The millennials, Gen Z, they are participating in one aspect or another of crowdfunding, of alt. And I think for them to blindly go in the stock market, they didn't have the comfort that, say, many of us with a bit of gray hair or no hair, on this call has, where the market just boomed kind of in the 80s or 90s, a little hiccup around 9/11 and the tech boom, and then boomed again. A lot of folks did pretty well over, say, the formative years of our life. The younger folks have it way differently, which I think the youth will provide some education to our generation as we get older collectively, which will lead to more dollars shifting into the alt side.
Hey, everybody, and welcome back to another episode of the Real Estate Rundown. It's not often we get a Wall Street insider on the show that's going to help us understand some of the things that are played in the game that aren't to our advantage and how to really maximize that advantage for us. And today, the guest we have is a gentleman by the name of Dan Kryzanowski, who has spent time on Wall Street and now has made it his mission to help people use their self-directed IRAs to own real estate, to own assets, and to really make a difference. So, Dan, welcome to the show.
Awesome, Shannon. It's great to be here. And, for our folks, congratulations. We made it through 2023 and time flies. I got to tell you, brother, it's been a good 10 months since we last saw each other in person. And, we'll see each other soon coming up in the new year. So I'm really excited to be here today.
So, Dan, let's just start with a little bit of your experience. I mean, you've actually been on Wall Street. You've actually been involved in the machine that a lot of us work against in layman's terms. We help people get their money off of Wall Street, invest in Main Street, do the things that are necessary to truly create wealth. Where did your career start and where did that take you?
Yeah, Greg. So, grew up in Scranton, PA. Like many of us Gen Xers probably had parents that had some sort of pension, what did their 9 to 5, maxed out, very different than I feel you and I, or frankly, our grandparents growing up in the Depression. So with this as a background, found myself at Wharton for undergrad, of course, graduated, went right to Wall Street, as many of us do. And, for a good part of a decade, I blindly followed the process. I did my 4 or 5 years on Wall Street, a bit more hair back then, and such. Had a good time. And but I was trading. I was on the equity side of things, equity derivatives, trading ABC, XYZ. In hindsight, it really didn't mean that much. It wasn't very tangible. You're just trading paper and a little bit of delta here and there. Post MBA, I did my master's at Thunderbird. I was with GE Capital. So, for us younger folks, GE was kind of the Google of a, generation or century ago, a top company, but very, as you can imagine, very top down. It used to be the GE dividend was a big deal at the time and the GE stock at the time. And I always had an inkling, though, even going through 2009, 2008, that there was more than, say, as an investor, particularly with your retirement, the Fidelity, year 2050 target fund. So I was very fortunate to have a taste of Austin back in 07, 08, and then, find myself down here on a short trip where, as I say, keep Austin weird, but it's also been like that on the investment side. So, some of it was just very situational. To be honest with you, if I stayed in a cushy job in the Northeast, we probably would not be talking right now. And I would just assume that my 60/40 stock portfolio was going to magically, work out.
And this is the thing, and I don't understand it fully either, but we believe that the system was built for us to succeed, and we follow it. And you said blindly, and I don't doubt that a lot. We go to school, we go to college, we do, we invest in our 401ks or our, pension plans, and we do those things because that's what we're told to do and we're taught to do. And as you have now been on both sides of that table, you've seen that it doesn't always become the most advantageous. But it's interesting to me. I mean, we see advertisers spend thousands and thousands of dollars a second for Coke ads and for Nike ads. And yet we don't think that the Wall Street machine has done the same, and we hook, line, and sinker that stuff. But, now that you're out on the other side of that and you're seeing what that's looking like, what are some of the small fundamental changes that you see when an investor takes their investments into their own hands? They start thinking for themselves, doing for themselves, exploring for themselves, and finding their own solutions. What are you seeing that does in the overall scheme of things in it and in their wealth creation?
I think first of all, it's on a personal note. I mean, I had a great breakfast this morning with the doctor here in Austin, and she pretty much said, no more. I'm not doing the full hours. I might not even do half time. I will, as she said, I will burn out. And then financially, I don't know if I would even get there, or eventually I would get there, but my kids will be in college. What's the point of all this? So I think first and foremost, folks realize that the reason to be a passive investor or to play in the alts is to control your schedule, to control your time, and or to supplement to get to a certain goal faster. So I think a big part of it is empowerment, both in terms of times and dollars. And then secondly, something as basic as come tax time, instead of getting this big, or I should say relatively simple W-2, okay, your taxes that play back to your 9 to 5 job, you get to see the write-offs and everything else that kind of goes in with it. And the big proof point for me was one of my real early, I know we go to a lot of conferences, family office shows where, very much in front of an open crowd, every family on stage said, less than 10% of my stuff is publicly traded. We are wealthy, not now, but for prior generations and future generations, and tend to be wealthy from private investments and primarily in real estate. So for me, that was the super big proof point that says, okay, these folks know what they're doing here.
Well, and it's funny because if you're involved in active trading on Wall Street, there's a lot of people that do day trading and they make a good living at it and they do that kind of stuff. And then, there's massive portfolios on Wall Street that do the same thing. But, every time you make a profitable trade in Wall Street, there's little or no tax protection, right? So, I mean, you've got to think that if I take and invest $100 and I make $50, that's going to apply to ordinary income for me. So that's taxed at upwards of 30% in most of our cases. And then you look at that and you say, I can't leverage that, right? My $100 is only my $100. I might get a margin account, right? Where, I mean, the average American might get what, 20% margin. So now your $100 becomes 120, which means instead of 50, you can make 60, but you're still paying 37%. So at the end of the day, it's not all it's cracked up to be, right? Where when you look at real estate, you can get, 60, 70% traditional, normal. I'm not talking about 21 and 22. I'm talking about the last 3 decades. You can get 60 to 70% leverage. You can then do tax strategies and preferential treatment that allow you to do things like that minimize your tax return and minimize the amount of income you're paying tax on, also reduces your rate of how you pay taxes based on the duration that you hold it. But all of those things can be done outside of any retirement vehicle or anything like that. Why is it that you think, Dan, that a lot of people just ignore all of that and say, nah, I'm going to give my money to somebody else. I'm going to let them deal with it.
Yeah, I think a lot of it is, one's identity gets caught up. And for me, it's easy from being on Wall Street and my Wharton buddies. When I say, well, what do you invest in? They're like, well, I'm like, no, not you, the $10 billion private equity fund, you, the guy that probably still makes a million a year. Good point. I have a buddy down here and he was with one of the early venture shops here in Austin. And it amazes me that his day to day was involved in venture, but his retirement, and he was already in his 50s. So he's approaching that magic number 59 and a half when you can pull out without penalty. It was still in mutual funds. And I'm like, try to crack him over the head. Like, what's going on here? So I think some of it's from an identity perspective. And the other is just the action, the set it and forget it. It amazes me how many folks have an orphaned account, sometimes not just from their 20s, but from their 30s or 40s, that's sitting somewhere, probably half in cash and half in, a bond fund seemed attractive at the time 15 years ago. And it just kind of sits there. And folks really think, well, that I think that ultimately folks don't view this as one life. It's two very separate points. And first of all, you got to get to age 60. And then thereafter, you have to hope that the principle and such is still there. So, I get it. The stock market generally goes up, but, people, when they do dip their toes in every 5 or 10 years, they tend to trade at the bottom. They're not, they're not buying low, selling high. They're doing the reverse. So a lot of folks shoot themselves in the foot and then they think they can make it back. And it's just a horrific situation. But ultimately, I think to your earlier comment, it has never behooved the Fidelities and Schwabs of the world to offer this product. I know they have attempted at times, but it's just slightly complicated from, to your point, a big picture ad that comes between a Nike and a Coke commercial.
Yeah. And the thing that I look at is so often we as humans want the easy button, right? We want to be able to say, well, I have an advisor that does that, right? I've got a personal trainer that's going to make me look like Arnold Schwarzenegger. It's not the personal trainer. It's my efforts. Now, the personal trainer might be an accountability factor, right? But so often when it comes to our investing, we don't even do that, right? We just shovel money over into an account and we trust that our advisor is doing the smartest thing for it without ever tracking what is he taught to do, how does that philosophy line up with what is best for me, right? And then what are the results that I'm getting? I've listened to people complain year after year that their financial advisor keeps talking about this year's going to be the year. This year we're going to see the returns. I know we've had some of this and I know there's fees involved, but the reality of all of that is that we don't want to take responsibility. Like you said, there's two lives, and we don't want to take responsibility for our finances, but we can absolutely bet that Wall Street's not going to take responsibility for ensuring that we have a retirement that we had envisioned, right? And so, how do you look at getting people to break out of that mindset of, I'm going to let them do it, to I'm actually smart enough to do it myself? And I have a hell of a lot more invested in this than my guy at one of the big firms or even, your local guy that, is a wealth manager. How do you help people?
Half the time is just asking them because we're talking about two buckets here, your cash and your retirement. So for me, and this is just, almost dumb luck, I ask folks, well, what do you do with your cash? Or tell me about where'd you go this weekend? Oh, I went to my beach house, or we have a rental. I'll refer back to my breakfast this morning with the doctor. Well, we have a short-term rental for tax purposes. How's it doing? Well, actually, it's doing pretty well and it's cash flowing, and we expect to sell this. This will be a double-digit gain. I'm like, okay, how's your retirement? I'm a little scared to even look at it. Okay. So all else equal, even if assuming it wasn't too scary to look at retirement, typical 60/40 or call it even an all equity, let's say this was in your retirement bucket. Wouldn't it be nice to get double digits off real estate that, your retirement is managing, or somebody that you're close with that you write a passive investment check to that you can check in? Because last time I checked, I really can't call Coke or Nike's headquarters or Merrill Lynch to say, hey guys, saw the stock went down $1 today. Let's have a chat.
Let's talk about some accountability over here, guys. I mean, come on. What are we not pushing enough product? What we have another market we need to expand Coke into, guys. Let's get after this, right?
I heard the moon is opening up pretty soon, or Mars. So, who knows?
But you've got such a great point there, that there's a disconnect, right? And I know that we, again, as humans, we don't like to encounter the pain, right? David Goggins' book, he talks about embracing the suck, and there's not a lot of us that want to do that. But, and I think the fallacy is that it's hard, right? That it's going to be difficult to manage our own. We've got a full-time job. We've got kids going every direction. We've got a career. We've got all of our social groups. We've got all these things that we want to do. And we don't really want to take care of one more thing. But if we don't, that one more thing will never take care of us, right?
And it's amazing, not just our coupon clippers or, grandma that's looking for the best certificate of deposit rate, but it's amazing how some folks will micro focus on a certain portion of their current liquidity, their cash, kind of like a spirit of analysis paralysis vis-a-vis the big picture. Or as I said, they'll take an action and an old fraternity brother I'll call up and they'll send them a check for 5K for their next restaurant idea. It's like, okay, where's that going? Kind of nowhere. Well, I get to write it off. It's like, okay, well, you're losing money, to kind of make this clear.
You had to light it on fire to be able to write it off.
And let's say, we'll say somebody that does have expertise like a VC. It's like, okay, you have a decent eye for startup. Well, if you think this is the next Facebook, think of a Peter Thiel, with PayPal. Why not use a Roth account? So you don't pay tax. Why pay taxes? So the other analogy I use, which is helpful, is I say, well, especially I think kind of working with the Roth conversion, people kind of get and they can see, well, do you want to pay taxes on the little seed or the big forest? And I do the seed versus tree and then forest analogy to say, okay, you can even use your Roth now in stuff that you probably have a spirit of expertise if you're investing passively. Myself, way back when I was part of a prop tech company in self-storage before storage was the hot niche. That served me extremely well to earn, 30 plus IRRs in my Roth portion of my retirement. It also helped on the cash side. Don't get me wrong, but I view to say, well, what am I comfortable doing on the cash side? Why? And it's a sponsor I know, like, and trust that I can call, that I can find, vis-a-vis kind of the diversified sort of fund out there. So for me, it's becoming more of the one thing I think that is in the favor though is that the millennials, Gen Z, they are participating in one aspect or another of crowdfunding, of alts, where, and I think for them to blindly go in the stock market, they didn't have the comfort that, say, many of us with a bit of gray hair or no hair, on this call has, where the market just boomed kind of in the 80s or 90s, a little hiccup around 9/11 and the tech boom, and then boomed again. A lot of folks did pretty well over, say, the formative years of our life. The younger folks have it way differently, which, ultimately, I think the youth will provide some education to our generation as we get older collectively, which will lead to more dollars shifting into the alt side.
Well, and then let's talk about, let's say you did set it up wrong. Let's say you did a traditional, right? And you've got money in your traditional just because you started wrong. Does that mean you got to continue to leave it in a traditional IRA, or is there ways to solve that problem now?
No, there's many aspects. And, wrong is always a unique statement. In some ways, well, I put 5K in my buddy's startup idea. All else equal, the best money to lose is traditional pre-tax IRA money because you never pay taxes on it. Now, I'm not saying that's a strategy, of course, or
It's finding the bright side in a dark event.
it is. And then, on the other side too, it's also the flip side. Well, I feel pretty versed, or all else equal, this 100 that's in traditional, or it's, let's say it was 50 and 10 years later, it's 100, even if this was in stocks or funds over time. Well, maybe I can 2X, I can get to 2X in the next decade because my buddy does this thing called notes and it seems pretty good, kind of this 10%. And I conceptually understand, because I had a mortgage before, mortgage, senior debt, LP equity, and kind of this middle stack, especially in our real estate world that we're seeing kind of in the promissory, pref equity, whatever you want to call it, kind of that middle class that, even when stuff hits the fan and deals, they're probably going to sell where the senior and the promissory gets back. Maybe a little tough cookies for the equity. But my point here is that if your goal is actually the Roth conversion, at any time you can do it. Yes, you will pay a little bit now, but so as long, especially if you don't lose that principal over time, it's really going to work out in your favor in the future.
Hey guys, real quick. If you're enjoying this show, I want to ask you to please give us a 5-star rating and review on whatever platform you're listening to right now. Leaving us a rating and review takes just a few seconds, and it's a great way to show your support for our show. Your support helps us reach more listeners and create better content. Thank you very much. We really appreciate it. Now let's get back to the show. Well, and it's also one of those things that timing has something to do with it, right? I mean, it's, if you're having the best year ever, probably not the best year to do that conversion also, right? But looking at some of those things, I mean, it's a strategy game, but it's not that hard, right?
It isn't. And, for folks that there's a lot of ways to go out, especially if, collectively you're transitioning from a W-2 to a 1099. You're in a whole different world of write-offs. Everything from the weight of your car can significantly impact what your net tax rate is. So, you can get pretty negative in a healthy way via Roth conversion in a good way. Or, a second situation for all of us, many of us that have started up a company, year zero, you tend to really not take much salary. So, you want to hit that magic, whatever your number is from a conversion, the 200, the 300 range is looking good. And then finally, it's just part of your financial plan where, we're going to bang out 50K a year for the next 5 years or 10 years. And that's just what we pay on now because we can afford to do so.
And you talked about and in your early years in Wall Street, you were trading on small margins and you were doing a lot, but you were doing with large volume, and you've done something similar in your business where over the last 18 months you've talked to 500 people, sponsors, syndicators. Were you just looking for a small nugget from each one? I mean, was that kind of the same thing? Do the numbers? I mean, that's a person a day and working weekends. What were you getting out of that?
Yeah, I think one is just how I'm wired and it's a natural interest. And otherwise, I think everybody, legitimately has what I call a superpower here that you can learn from. And, it wasn't literally one a day like people that do their 10 push-ups or otherwise, but some of it, a few liberties in the number. But to be honest with you, I'd say at least was a legit 15-minute conversation, best ever conference where we met. I would say you can include a good 10 new people in addition to other folks that I knew almost each day that I was there that I purposely wanted to sit with. And there's a lot of things to learn. Our friends that kindly sponsor some of these events around the tables at the events, because they're going to have domain expertise in the asset class, in the real estate. There's a great one pretty close to me, but in the Texas Hill Country, and their duration was 25 years, which seems silly, but you think of, well, it's wine, something's with farmland. You're like, all right, that's a unique play. And then you can roll it back a little more. And in addition, here's some other tax benefits. You're like, oh, I get why you're at a type of show like this. So, and then a lot of this is just these are little nuggets because I think ultimately when we're talking to investors, I think theme of our call is folks at least considering that there is another side of the rainbow here. Not being an expert, but knowing, I talked to two or three people that you like mineral rights. This can actually be really much in your favor. Let me see if I can connect you.
Well, and that's, I was just talking with somebody else about, when my son decided he wanted to explore his options in real estate, and he was, 22 years old and had the fresh face that comes with that. Dan, you remember that face, right? The thing that I told him was connect with everyone, right? I mean, I don't care if it's the guy repairing dishwashers or other realtors or mortgage people or, whatever it is, because having, just like you were talking about, having that connection to others allows you to connect others through that. And then people look at that and go, hey, you know what? I need to call Dan. I haven't talked to him in a while. I want to see what he's up to. Oh, is it mineral rights now? What's he exploring? What's he know about? Because being able to be knowledgeable to a, you know, to a minor degree on a lot of things allows you to give people opportunities to connect on things that they may have more interest in, but it also gives them that connection back to you. And, people like to know that, hey, you know what? I can always call Dan because he knows a lot of people and he's able to do that. But when you're talking about, self-directed IRAs and you're talking about those kind of things, I mean, the world opens up and I know that a lot of people not only, but primarily think about using their self-directed IRA for real estate. But as you continue to mention the alts and the things like that, you've mentioned notes already. What are some of the other investments that you've seen people invest their IRAs in other than the fraternity buddies new restaurant?
Yeah, I mean, so a quick blanket answer is, and I'll answer it two ways: is what you cannot do. Similar to, I'll give you an analogy with the health savings account. Your kid breaks their arm, you can use your HSA card. You want to buy a Tesla. Sorry, that's not really covered under the health side. Same deal here. No life insurance, no collectibles, not yourself or your linear family. What does that refer to? Well, your kid has a startup idea. You can't go there. The beach house, your parents can't stay there on the weekend. Everything else, cannabis is still a little bit of a gray area. Everything else is pretty much in play, which is fantastic. So, as I think about it, this is kind of where I think head and heart comes. Our folks say, I've had a good career. I have $1 million in my 401k. My house is paid. My kids are out of college. I want to start giving back. Well, let's say, you have an affinity, as we say, female entrepreneurs, the other side, folks on the other side of the tracks. Your investment over there will replay and reshuffle multiple times over, and you have this huge pocket of money that can go into it. So, I said I've had great success as an investor, not even angel equity, but angel loans, like true day zero loans. And no surprise, guess what? The females tend to actually pay and they're more responsible and a better credit. So, just saying. And no, but that's been actually very impactful for me. I'm fortunate to still do about 50 mentor calls a year through Capital Factory, probably invest with a company or two. I do have sincere respect for the true, literal and figurative immigrant sort of mindset of somebody that has, an impactful idea of, well, here's how life's going to get better for folks in Ukraine when this ever stops. Wow. Okay. Like, I get it. That's more still on the startup side, but other things too. Private loans is pretty solid. Crypto is in play. Obviously do your diligence on that. Could you still use your self-directed for stocks and bonds? Yes, you could. That's a question ultimately you get asked. It's an account. It's a security. I see a lot of times it's folks that's either in their public niche. So, a doctor might invest in an established cash flowing biotech company, for example. or other folks, I have to say they moonlight here and they follow something unique. And as I said, the nice thing here is it's not just going into a stock or into a startup world with, especially in the US with all the different convertible notes and everything. It's kind of a zoo. And frankly, it's very challenging to make money. But once again, you have expertise, you're helping some old colleagues, they have a very established, and maybe you're taking a revenue share. So my point here is you're also going to be a little creative in the structure of what you're investing into. Obviously have some be a lawyer, play lawyer, et cetera, a little bit, do some diligence here. But I think it does come back to, especially as we get to our later stage in life here, kind of where head and heart is and who you want to benefit. And yeah, pretty much a whole lot of things are in play.
Yeah. Well, and like you said, rather to lose, money to a cause or money to something that you believe in, startup or otherwise, where you can be able to take advantage of that because, especially if you're in a traditional, right? You put the money in there, it's pre-tax. You do a deal in a startup based on a cause. If the cause, it's not that the cause is going to go away, but if the idea doesn't work and the product doesn't happen, better to have done it out of that account than to have done it with the I'm going to eat money, right? And so, you know, looking at all those things and all those things you mentioned, what's the most surprising slash crazy investment you've ever heard of somebody making out of that?
Yeah, no, this is fun. And there's two kind of, I just want to close on your comment on the head and heart. I have a good friend, we went to Wharton together. He focuses on a school with kind of a new age sort of method. So here's just going back where I think it's so important to consider these two buckets of money on the retirement side. Let's say I cut him a check when I was 40 years old. I don't intend to touch that money for 20 years. This is a very long term play. It's almost like a very slow played consulting model at the end of the day. It's students times tuition. There is a real estate piece and more into it, but my point here is that would I do this with my current money, my cash? Probably not, because I know it's going to be a 10 to 15, 20-year play. But boy, is it exciting and fun to do, here. And there's other benefits of the community, the investor community. Even though it's my IRA, it's still me, the individual. The one thing, and it goes back to real estate, I was fortunate in my early days at Rocket Dollar to meet a few pilots. And much like being a senior in high school, when you're 59 years old, you're the cool kid because you're about to retire or be kind of pushed out here. And, one gentleman I met, a great fella, said, well, that's me. Personally, I bought a condo here and my retirement, my $1 million here, let me roll it into a self-directed and buy, four condos up and down the street. So although he could not personally benefit to stay in these other four, he didn't need to. He could not personally change light bulbs. He didn't need to. He had a maintenance person, but he can collect the checks and know that his retirement's assets were right here in front of him. If he ever had that gut feel like, a hurricane, it's coming, man. It's going to come every year for 10 years. His retirement could have sold that and turned around and, bet in some of the notes with some of our buddies here at 10 or 12%. And I have seen the same person diversify in that spirit. So, not super crazy, but I think that's just a kind of a cool story that this guy flies over this and plays the island and somewhat a very stereotypical pilot story here.
Yeah. Yeah. Well, Dan, what is some of the pitfalls that you see people should be looking at when they're talking about the retirement money that maybe people won't normally think about?
Yeah. First and foremost, I think it's, are you on state not to over contribute? It's funny when I was at my early days of GE, I just think how the calendar or however things played out, I actually went over my contribution and the way things were set up. It wasn't obvious to me. There wasn't an email, there wasn't a text to say, you maxed out your 18 or 19 or whatever it was. And I get these things in an envelope that are they weren't bearer bonds, but they feel that way to me. They're treasury sort of things that it seemed very antiquated and weird. But my point is that I went too far, not often, but once or twice in my career, where you actually went over the limit just from a contribution standpoint, when maybe at a certain stage of life or career, it could have been better to be liquid and have cash over here. Now, on the other side of the coin is I know a lot of folks might say, oof, markets are tough. Even if I'm an alt investor, I'm going to sit in cash. One, you might be in a cash account earning zero. Please don't do that now. And when you look at the real interest rate, how things may or may not play out. And I think we're in a relatively, from a rates perspective, plus or minus 100 bips, but it's just my personal opinion here. But also it's, be aware of inflation and certain things that you're not way behind. So I think always being aware of your personal portfolio allocation, having money in use, I do feel And this is where I love kind of that middle stack of promissory notes, note investing, things that generally have either a redemption or I think more so just a quick turnaround. So I think that would be a final point too. Is just much like how like grandma likes to stack her certificates and deposits. Different banks, different tenures. I think in the same way, kind of on the alt side too. Kind of gauge, and there's not an exact date sometimes, but gauge when money maybe could come back and where you can put that elsewhere. So just be aware, like, hey, check in. It's your money.
Right. Yeah, exactly. Exactly. Well, when we look at investing, I know a lot of people start too late. You know, a lot of people, they don't get in the habit. This is one thing that I told my kids, you're never going to live cheaper in your life than you are right now. Right. So if you're thinking in your mindset that you're going to wait until you're 52, or sorry, you're 32 to start doing that, or you're going to wait till you get that next raise or things are starting to go better. If you're waiting for that, you've got the wrong mentality. I mean, I get it. Our first jobs, I mean, we were barely making enough to survive, but also saving 5% of survival mode is no different than saving 5% of millionaire mode. It's just the number looks different. It's the habit that you get into. What are some of the things that people should look at as far as how to really start to build that nest egg if they're starting a little late so that they can do the investments? And at what point should they really look at, I've got enough that I should get started? And all
I think it's always a good time in alt. So I think even if one would not be classified as a saver, as life has played out, there's probably a decent chance that at some point in one's career, say even if you're 32-year-old, you might have 20 or 30K stacked in some 401k, probably a rollover IRA. That's enough to be dangerous, even if it's just one or two investments here. So that's one way to go about it. The other one, and there's my favorite, a book, Die with Zero. And it was so late. It was funny. I was on a call last night with the group, and they're like, "What's your favorite book?" And I just like, "Oh, I wasn't at home." And I'm like, "I can say Rich Dad Poor Dad," but everybody says that, because we were talking about earlier in the day. But the concept of Die with Zero is, folks get to a certain point and they think they're not going to have enough for retirement. Say they have $1 million and they go skydiving, but then next year they can't go skydiving, and then something else and they can't do it. And then, they're 80 and that one, and they did all the stuff they wanted to do, but not as many times as they wanted to. And they're 80 years old and that million has magically turned into, maybe 2 million, let's say, even if with stocks or bonds, or three or four or five with alts. So, the point here is that you got to get to that million. So you have to start contributing. So I think, especially for folks on the call that I'll say has a legitimate trade, a doctor, something that is high in demand where you can pull in and out, or let's say cybersecurity, if you're working for a pension system or the military and you have a few years to go. When you kind of have that surety, when you can kind of tap in at any time to work, I don't want to say worst case, but kind of on an hourly perspective or a project perspective, that's a huge advantage. So if that is your avatar, I would get really serious about putting some money away, because even if you're a little short, you're basically an essential business. You're an essential employee. If that's not your go, if you're, very much the entrepreneurial, you like having, sweat equity and such, and that's the way you play it out is, to your point, there's an inflection point, especially if your big nuts are every like 3 or 5 years when you get paid out. If you recently had an exit, take care of the house, take care of the college tuition, and then, make it so even if it's, 20 or $100 a week, just set it and forget it. I mean, literally a coffee or a salad feels like it costs that much these days. And frankly, we might get there pretty soon. So
I don't know what salad you're doing for 200 a pop, but I'm sure it's got kale in it.
there's a lot of kale with a little bit of gold mixed into it, I was
Yeah.
told. So
Yeah. Yeah. Well, Dan, what advice have you got for people that you learned on Wall Street that people don't realize can be super beneficial? I mean, we've just talked about throwing the baby out with the bathwater, right? What is the advice that you can give them that says, hey, this is what Wall Street does that you can do too, and you should?
yeah, absolutely. So I think it's recognizing your network. I mean, half of Wall Street is people knowing people to move more money to a certain place. And guess what? We joked a little bit on the marketing side, but there is a fair number of fees that go into this. So, same way I've met a fair number of folks that say, hey, people look up to me, to my opinion. And I say, well, have you heard of an SPV or a fund of funds? They said, no. I said, well, if you had simple numbers here, you have 10 of your buddies at 100K and you do the legwork, many sponsors in very simple terms have an A share and a B share, and there's probably a delta in the middle. And this is all legal, all above board, that for your time and efforts, you can take advantage of those two share classes. So, that's one thing that I'd say. I think it's just really to take advantage of your network. And then at the same time, legitimately read the small print. My advice to any investor, especially a novice, is, I'm going to hand you $100, invest on January 1st, 2024. How does that look if everything plays out as it's supposed to? If it doesn't, at what point is my 100 in danger? At what point is this X percent? And, and if people like benchmarks say, well, with these certain fees, what is it going to take for you to even hit the benchmark? Versus me investing in the spiders or the Qs. So and if folks can't, I always say, it's just more on the alt side, my advice for different sponsors, that's a very elementary question that I think it's very wise to be able to answer, is on a net basis, based on you, or more so, you're in a state that has state income tax or otherwise, here's what your net is going to be, and then kind of work backwards from there. And once you are actively investing passively, it's a bit of an oxymoron, but think about what bucket of money is going to be best for each type of investment.
Yeah. Dan, this has just been a lot of information, and it's obvious through the conversation of your wealth of knowledge. If people want to get in touch with you and learn more or drill down a little bit or have questions for you, how can they get a hold of you?
Yeah, so LinkedIn is the best. No surprise, there's not too many Dan Kryzanowskis in Austin, Texas. If you can spell it correctly, yeah, that's a bonus point right there. But no, I actually do. I do check my LinkedIn, and please share that. Hey, Dan and Shannon had a great discussion, and or here's what I'm interested in, because I'm sure, like you do get a fair amount of incoming and emails just as zoo these days. But no, I do take the email seriously. I'm sorry, the LinkedIn, the one-on-one seriously, and very open to have a one-on-one with folks. So I appreciate you and your audience here.
Yeah. Well, guys, hopefully you got as much value out of this as I did. It's funny. Half the reason I do these podcasts is so that I get to learn and not sound stupid while I do it, because a lot of the questions I've asked were for me. But Dan, I want to thank you again for coming on. Guys, if you want more information about Dan, his contact information is going to be in the show notes. You can also reach out to us at shannonrobnett.com. And as always, guys, be sure and subscribe and like the channel. You're going to get more content like this, and you will be up to date on when that comes out. Once again, guys, thanks for joining us here on the Real Estate Rundown. We hope you have a fabulous week with your investing future.
Thanks for listening. I hope you found tons of value in this show. It would help us a lot if you could rate and leave us a 5-star review as we continue our mission to help others just like you in their real estate journey. Thank you, and we'll catch you on the next episode of Robnett's Real Estate Rundown.